Cisco's ticker page is lighting up the Yahoo Finance platform this morning after a better-than-expected quarter. The company also announced a new restructuring plan as the economy slows. Cisco CFO Scott Herren rejoins us now. Scott, good to get some time with you again here. One thing I keep seeing in a lot of these analyst notes out this morning is a decline in product orders. Take us through that decline. How concerned are you about that?
Yeah, Brian, good to see you again as well. So we had a great start to the year. This was a record high revenue for us. It was the second highest quarter ever for earnings per share. Demand came down. Remember when we talk about demand, product orders, right? That's comparing to a Q1 last year that grew 34%. Right, so the year-on-year compares are skewed by the size of our product orders a year ago. The better way to think about it then is sequentially. What was Q4 to Q1, and how does that compare to a normal trend for us? It was within about a point of the historical range we've seen. So this was a good quarter. Demand is holding up for us.
So that is the big question. What does normalization look like for the business, especially as we think about pre-2019 levels and what the growth metrics were that you were looking at coming into the pandemic that you can start to see reemerge and kind of stabilize at this point?
I see networking, security, and collaboration as being in significantly higher demand than they've been historically. Every company right now is adjusting to the new reality of work. Right, it's not you don't come to the office to do your job anymore. You come to the office for different reasons. Right, what that means is the office needs to be reconfigured. Part of the restructuring that we announced is about reconfiguring and taking down the amount of office space we have. So there's demand for networking in the office. Every home is like a branch office now, right? So you have to protect that. You have to get good networking there. Obviously, you need security around it. So the growth opportunity for us longer term, we talked about this last year, is somewhere in that 5 to 7% compound annual growth rate range.
And can you talk us through a little bit more of the restructuring, Scott? It's Julie here. In terms of headcount, what effect it's going to have? Because it sounds like you're not, that the headcount from the beginning of the year to the end of the year is going to remain unchanged, but there's some movement within there. Can you explain that to us?
Yeah, you said it exactly right. It's good to see you again, too, Julie. I think what we're doing may be a little bit different than what you see from some others in the industry right now. There's two elements to the restructuring we announced. One is right-sizing our office space, as I just talked about. We've got a lot of office space that is either unused or significantly underutilized. So there's a piece of it that's just right-sizing that leased office space. The second is we're constantly looking to invest in areas that drive faster growth, to the question that was just asked. As we do that, we want to focus more resources in areas around a single platform, single operating platform for our networking products, around more cloud-delivered capability, and around security. And so what we're doing is, in order to add more resources into those areas, is we're coming down in other areas. Our goal, by the way, will be to minimize the number of people who actually leave Cisco. In some cases, what we're looking to do is actually take the people that are in areas where we're going to reduce and place them into jobs in where we need to add more resources. So the goal will be to minimize the number who actually leave. And by the end of the year, we think our headcount is right about where it was at the beginning of the year. So this is not motivated by strictly trying to save cost. We didn't go through the huge buildup that I think a lot of companies did during the pandemic. So we're not at a point where we just have to reduce cost.
Scott, there could be existing or net new customers that you're having talks with, trying to upsell some of those portfolio clients, but also trying to get new contracts with some of those net new customers. Are you seeing a stalling in these deals actually being brought over the end zone, brought over the finish line as companies are managing their own costs as well?
Yeah, Brian, it's hard to generalize to the entire world what we're seeing right now. It's a little bit different in Europe versus what we're seeing in APJ versus what we're seeing in the Americas. Europe has got its own set of issues, largely around energy and the rapidly increasing cost of energy, which when you do what I do and you've got a big piece of your cost structure that's very hard to predict, naturally you start to put more focus on where can I save money. And so we're not seeing deals lost in Europe, but we are seeing a little more pressure in Europe and in some cases more approvals added to the end of that, a little more scrutiny on those deals. What we see across Asia is actually continued strength. Obviously, they have an eye on what's happening in the rest of the world, but for example, 5 of our 7 theaters actually showed growth on top of what was a strong Q1 for them a year ago. So a little bit different in Asia. And then across the Americas, it varies a little bit by customer size. Enterprise continues to do quite well. Our U.S. enterprise business, on top of a very strong growth a year ago, continued to show growth in the quarter we just closed. So it's a little bit different, Brian, by customer segment, a little bit different by where you are in the world.
Scott, in a period where you're now restructuring the business and global growth around the world is slowing or just flat out slowed, what's the company's appetite to do acquisitions?
You know, we've always had a strategy around acquisitions. If you look at the amount of free cash flow we generate on an annual basis, round numbers, 13 to 14 billion. A lot of that we return to shareholders. The dividend consumes about 6.5. Offsetting the dilution of our equity plans consumes another couple million. That still leaves us with a significant amount of cash that we have to decide what's the best use of it. And acquisitions are a part of that, have been historically. I would say right now it's a little bit difficult. The acquisition market, you've seen it worldwide, has slowed down. And I don't think a lot of companies have adjusted to the new reality of valuations is the first part. And then the second part is the cost of money is higher. While we generate a lot of cash, you know, there's times where you can't actually access cash that you've got in different places around the world, and the cost of money is significantly higher now than it was, say, a year ago.
Hey, Scott, finally, as you talk about decreasing your real estate footprint, you're also changing it, it looks like. I have to admit, full disclosure, behind you is not what I would have expected a Cisco office to look like. That's what I would have expected, like
a Yahoo office,
or like a startup office in Silicon Valley to look like. Is this, I mean, is this what people can expect if they come and work at Cisco? That it's going to look like this?
Julie, we need to bring you to our office in New York.
Obviously.
So next quarter, when we do this interview, we'll do it from our office at One Penn. This is what offices look like at Cisco, and this is what offices are going to look like for everyone. The reason to come to the office now, post-pandemic, with hybrid work as a reality that everyone's adjusting to, is very different than it was historically. You come now for community. You come now to get together, as opposed to coming to set your laptop down and get your job done. If that's all you've got to do, you can do that from home.
Scott, let's get Yahoo Finance on that TV behind you. I see it playing. We'll take it offline, though.
Uh-oh, you're going to get an email from Sauce following up.
I'm actually sending it right now.
We'll leave that to you guys. Scott, thank you
right.
so much. It's good to catch up with you. Cisco CFO Scott Herren, appreciate it.